What's up, guys? Mike Sharp here. This is Sharp Investing. Happy New Year. I am going to do a portfolio review, quick one. I'm not going to review all my moves, but I will review the significant ones in this video, and I will also take a look at my goals for the year and what I've done this year in relation to those goals, and set a few goals for next year. All right, so first off, the big number is the annual return, which was 39.99%. I'm going to round that up to 40% on the portfolio. So I'm quite happy with that return. The S&P returned 26.3%, including dividends. And so the Sharp Investing portfolio outperformed by 13.7% this year. And the reason I'm feeling pretty good about this is because last year, 2022, when I first started the channel and keeping track of this portfolio on January 1st, basically the market was at a top. It was close to its peak all-time high, and then in 2022 it had a down year. The S&P was down 18%, not 1800, down 18%, and my portfolio was down only 9%. So I had an outperformance in a down year of 9% and an up year of 13.7%. Which means that a two-year return on my portfolio is 23.8% versus the S&P, which is only 3.4%. So that's an annual CAGR outperformance of 11.1. So I'm quite happy about this, but the problem is it's only 2 years and sort of anything can happen over a short term in the stock market. So I'm not ready to declare victory yet. I have seen too many people declare victory in various parts of life too soon, and they always end up paying for it. So I'm going to try and keep humility about this and say that the war isn't won yet. I'm just going to keep continuing to try and do my best in the market and learn. And you guys are a big part of me learning, because if you guys weren't watching, I wouldn't feel like I have the accountability that I have. And I actually think that I've become a better investor over the last 2 years, just having this channel active. As a reminder, I was investing for quite a few years before that, and I think that the improvement I've had in the last 2 years is actually quicker than probably a lot of the other years prior to that. So I'm going to keep going. I'm going to keep doing videos, and I just want to thank you all for subscribing and liking and making comments. It really gives me motivation to keep doing the videos. So thanks very much, and let's get on with the individual stock performance. So I'll do the stock performance and then I'll do the goals afterwards. So let's start with the bad stuff. ASOS was my worst performer this year. It was my worst loss I've taken in a very long time. I lost 54% of my investment in that company. And the lessons here are, well, I'm going to go back to Buffett. So Warren Buffett basically wants he would rather have a great business at a fair price than a fair business at a great price. I thought I was getting a fair business at a great price here with ASOS, and I thought that it was just cyclicality and was going to turn around. And the business looks like it has fallen apart in the meantime. So that was a lesson in not really having a margin of safety. And specifically on the profit margin side, their profit margins are very thin. So if anything bad happens to a very thin profit margin company, the fixed costs end up really hurting the business because they can't absorb a revenue loss. Whereas if you have fatter margins, you can absorb, basically you can take a punch. So ASOS got punched pretty hard and they're still struggling to recover from it. And I guess going back to Buffett again, I think that if I'm looking at his results, he doesn't get everything right. Nobody gets everything right. He probably gets, 50 or 60% of this stuff right. But I think he wins because he never really takes big losses. Well, I guess he sometimes does, but he's really minimized the losses and really taken to heart the Ben Graham lesson of, well, the 2 rules of investing for Ben Graham are: 1, don't lose your money, and 2, don't forget the first rule. so that's the lesson here. We all get wins. We all get we all get winners in our portfolio, and the question is, how many big losses are we going to take that are going to drag our results down? So I'm going to try and minimize these losses by buying better businesses going forward. that is my big lesson for the year. The ASOS was a big lesson, and another expensive lesson. I've had many of them in my life. So two other losers, BABA, you know, the most hated company, the most hated large cap in the world, I think, just continues to languish. It just can't get a break here, even though revenue and profits are now going up. The stock still is not reacting, and it was down 12% for the year. My return on BABA was better than -12, but still a loss because I had sold some of it at 115, because I thought the stock was sort of getting ahead of itself. Not getting ahead of itself, but it run up pretty fast. So I took a portion of it off. I bought it back at 82. And now it is lower than 82, but it did help me do better than -12%. Flow traders down 17% year over year from January 1st last year. And this is an interesting one because I always see it as sort of a counter-cyclical hedge. It didn't prove to be great in 2020 when the market sort of fell slowly, but I do think it is still a growing business under the hood. And whenever we get one of these sort of bigger panics in the market, I think it's going to do quite well because they make money on volatility and low interest rates. And both of those are down right now, or interest rates are up, volatility is down. So kind of a perfect storm for them. But I do see it as a hedge that if there's a really bad year in the market, I'm going to have a bit of protection there. Just on that note, like I also, in terms of cash, I had a sort of an average of about 10% in cash this year. Actually, it was more like 8. But if you take the cash out and the hedge out of this portfolio, so if you take out flow and the cash, the actual active long money that I was trying to win on was actually up 53.3%. So, you know, if I wasn't being as defensive this year, I would have actually done a lot better. But that's fine. I think 40% with some defensiveness in my portfolio, where I have about 25% of my portfolio that's defensive. I think that's really where I want to be sitting. I want to have some downside protection and still do really well. So let's talk about the good stuff. The good stuff, there's some big winners in the portfolio this year, as you may know by watching my channel. The smallest one is TEVA. That was a very quick trade. And, you know, the lesson there was, you know, just follow my rules. I had a set of rules and I followed them, and I got in and I got out exactly when I was going to. And that might seem like not really a lesson, but I think in my history, you'll see shortly here in my meta analysis that I don't always follow my decisions or my plans, right? And I think that cost me money over time. I don't think it definitely cost me money over time. So this is just reinforcing that when I make the plan at the beginning, just follow it, and it will some of the time work out well. Okay, so next biggest win, TEVA was up 40% for that trade. StoneCo was up 91% from January 1st to December 31st. And this was it was definitely a big factor in the 40%, because I did put this position up to 30% of my portfolio in October. There's a video of when I did that, and I did that because I really understand this company well, and I really believed that the market was getting it wrong, and I was willing to press my bet, or as they say, or as Lynch would say, water the flowers, right? So I did water the flowers there. I've been thinking a lot about watering the flowers and watering the weeds recently, being a natural weed waterer, so buying stuff that's kind of not performing well, let's say BABA, is my natural inclination, but this time I did water the stone flowers because their results have just been phenomenal throughout the year. They're just growing like crazy, and the thesis is working out exactly the way I hoped it would. So that was a good move, and I think that yeah. So water the flowers is the lesson there. Meta. Okay, so Meta was a good trade. I bought almost at the bottom when Kramer was crying on TV last November. And I did do quite well on this. My return on it was 104%, but I didn't actually follow my plan. My plan was to sell 50% and leave the other 50% just as a part of my portfolio because I think it's a wonderful business, and I was willing to let it ride. But I didn't do that. I sold the other 50% at 285 and ended up regretting it, right? Because the stock kept going up. Like, who knows where the stock's going to go? But the truth is, the sentiment and the profitability was shifting very quickly in one direction. And a lot of the time, most of the time, what happens is when the sentiment shifts, then you get a real powerful move in a stock, and it doesn't just stop at fair value, which is where I thought I was selling. It just keeps going through, right? Because you get the momentum. This could keep going. I don't know. I'm not making a call, but I think it keep going at 400 or 500 if the market keeps going up. So that was a lesson there. I didn't follow my rules, and it cost me money. So just do what I plan to do. There's the lesson. Last one is PDD. This one has also worked out really well. 108% up since I traded out 50% of my BABA shares for it in May. I had a pretty big position in BABA. I don't know, I forget what it was, 17 or 18% of my portfolio. And then so I moved half of that to PDD. And this has had a big impact on the portfolio, obviously, because it is more than doubled since I bought. And I'll talk more about this one in a second here as I review my goals from last year. But yeah, that was quite a good win. So if we go back to looking at last year's goal, the goals were basically do less and find one great business throughout the year, right? And so the first one, I did less, right? Like I really traded a lot less. I was a lot less active with my portfolio. And as a reminder, that do less is a Charlie Munger quote, and he's saying that's the reason that Berkshire has actually been able to beat the market. It was just because they do less, right? And so the proof this year is that doing less with my portfolio and just spending time understanding what I own more and more has actually worked out really well for me. And I'm going to try and do that even more next year. So maybe that might not be great for a YouTube channel because there might not be as much action, but it's going to be good for my portfolio, I think, over the long term. So the other one was basically find one great business, right? So if I look at my list here, find one great business per year, small cap, 200 million to 10 billion market cap, moat, high return on capital, long growth runway, high margins, pay fair or low price versus the growth rate. So that would be a low PEG ratio. And then I should be able to see minimum of 4 times upside over the next 5 years via the growth and the margin or the margin expansion, right? So I believe I found this in PDD. This is a scaled economy shared business that I believe is a scaled economy shared business. I haven't seen anybody else talk about that, so maybe I'm wrong here, but I'm not getting any confirmation bias. But I think this is a phenomenal business model where they are the absolute low-cost provider, and they're adding discounts on top of being the low-cost provider, which makes their offering pretty much unassailable. Like even from somebody like BABA, BABA might be able to get there, but TDD they run so lean. There's no overheads, and basically consumer to manufacturer model means there's no middlemen. It's just absolute rock bottom prices, and PDD uses their earnings on the advertising that's where the revenue is, the advertising, to invest back into further discounts on top of what the manufacturers are paying. So you're paying below manufacturer prices for stuff on their site. And I think that is just like, how do you even compete with that, right? So I think that's a great business model. The only thing that didn't fit there was the market cap size. They're a large cap company, and I was looking for smaller medium caps. But that's okay, because the point of the smaller medium caps is that they have a long growth runway in front of them. And I do believe that PDD still has that. So long story short, I would say I succeeded at this goal. And Yeah, I guess there's some other smaller goals here. So let's take a look here. I noticed that in 2022, I got excited and bought stuff before I'd finished researching it. And if you look back at my videos, you'll see there's a few examples of that. And I ended up having to sell them. I think I bought Sleep Number, and then there was, and then I think I bought Weibo. I bought them before I finished researching them. Then I had to get rid of them. So there's some FOMO going on there. Now I don't believe I did that in 2023. I can't find any examples of that, but, and PDD, I really did do a lot of research before I bought that. Even though I was excited, I still held off. I may have failed at this in 2024. I've just bought something else, which I will do a video on as soon as I get a chance. But, you know, I do get excited when I start finding something I think is really good. I'm like, oh my God, this is amazing. And then sometimes I buy them too fast. So that was a success last year. Maybe not in 2024, though already. I might have already failed at this one. And the last one was I wanted to understand the stuff I own better, right? And I believe I did this. This is the point of these videos is I do updates on the companies that I own every quarter, and that helps me be accountable and also to research a bit more than maybe I would. But I think if I'm going to have a long-term portfolio, then I want to really understand what I own completely. Okay, so other than that, I didn't do a lot of trades this year, which was good. So that's the do less thing. I had a lot of trades the previous year. And this year I did a few and they did quite well in them, but it was very minimal. I contained it to things that I thought were really, really high probability bets. So I guess the one thing going forward is I've realized that I mentioned this in a few other videos, but I've really realized something about myself. I've realized that I do need some action, right? I have to be honest with myself. I am not Warren Buffett or Charlie Munger that can just sit on a few positions and do nothing for years at a time. And so what my solution to this is not to just try to be something that I'm not. It's to contain my action to a corner of my portfolio. So I have 80% of my portfolio. I'm gonna put that as my long-term portfolio, 3 to 5 year holding period or more. And then there's 20% that I'm allowed to make moves with, like recently I bought QFin and Liberty Global and that TEVA trade that I talked about. I even trade currencies sometimes, or gold or whatever. So I'm going to contain that to 20% of my portfolio just to keep myself distracted and not touching the stuff that is actually going to make the money over the long term. So that's my portfolio strategy. That being said, let's talk about the goals for this year. I'm just going to keep it to 2 really, really simple goals. And they're basically the same ones as last year. So I need to find one more great business this year. Again, here's the list. It has to have a moat or some kind of competitive advantage that is very difficult to compete with. High return on capital, long growth runway, high margins, and pay a fair price for that. And versus the growth rate, right? So I want a low peg. And I have to be able to see a path to at least a 4x over 5 years. Okay, so that's what I'm looking for. And ideally it's a small cap, right? Because small caps are usually easier to get those kind of returns on because all the big money hasn't found them yet. So looking at large caps, it's quite difficult to find those kind of like compounders, but you can find them. So I think that's it for the year, or for the annual review. Again, good year, 40% up. I'll take that any day of the week. But there is the possibility here, like a lot of my stuff is pretty highly correlated to the BRICS. Well, it actually is in the BRICS countries. Like we have a lot of Brazil and China. And if there's some political change this year, or the markets, those emerging markets go down pretty significantly, my portfolio can be very volatile, and it can outperform on the downside. Let's see, I could really underperform the S&P if some of that stuff happens. So yeah, just want to point that out and say that I don't expect that the next 2 years is going to be the same as the last 2 years, because there are risks in this portfolio that I own. All right, thanks very much, guys, for watching. I will catch you in the next video.